Returning again to Project Alpha, the equipment has a book value of 0 and can be sold for $150 at the end of the project. The tax rate is 30%. What are the incremental cash flows from the sale? This shows the incremental cash flows that we got to in the previous module. $1,075 cash outflow in year 0, and then $341 for 4 years, and $75 in year 5. We've been told that the salvage value is $150, and that's clearly a cash inflow, so that's recorded in year 5. We've also been told that the book value is $0, so the profit is $150 minus 0, or $150. The tax on the profit is therefore the negative of the tax rate, 30%, times $150, or negative $45. That's also a cash flow. Even though some of these numbers are very similar, it's very important to understand the difference between a cash flow and something that is not a cash flow. The salvage value is cash that's received and is therefore a cash flow. The profit, although it happens to be the same number because the book value is 0, the profit is not a cash flow. It's an accounting entry. However, the tax that we pay on the profit is a cash flow and gets recorded. So these are the incremental free cash flows, including the salvage value and including the tax on the profit on the sale of the asset. We'll do a couple more examples with different values for the book value to see how that affects cash flows. Everything is the same in this example, except that the book value is now $100. Maybe tax law imposes some constraints on the amount of depreciation that can be claimed, but for whatever reason, we have a book value of $100 for equipment that is sold for $150. What will be the incremental free cash flows in year 5? We still put the salvage value in at the amount of cash received, $150. But this time the profit is $150 minus 100, or $50, and the tax on that profit is negative $15, a $15 cash outflow, resulting in these incremental free cash flows. In this third example, once again everything's the same except that we now have a book value of $220. What will be the incremental free cash flows in year 5? Again, the salvage value of $150 is a cash flow. The profit or loss is $150 minus 220. We've made a loss of $70. The tax effect is the negative of the tax rate times the loss, which gives us a positive number of $21. Because we can claim the $70 loss as a tax deduction, we pay $21 less tax than we otherwise would. So we have an incremental cash inflow. We are $21 better off as a result of the loss.